Hello guys. In this knowledge module, we'll talk about the equities or the stocks. We will talk about their characteristics and what are the basic types of stocks, and also we will use one valuation method to find the price of the stock. We will start with the types of the stocks and their basic characteristics, and there are actually different models to find or to evaluate the stock price. But in this knowledge module, we will focus on the dividend discount model. So we will use only one model, and then there are different scenarios. There is a growth of the dividend. So we will see that if the growth of the dividend is non-constant, how we can find the price of the stock, and then if the growth is zero, then how we can find the price of the stock, and if there is a constant growth, then how we can find the price of the stock. There are two basic types of the stocks. One is the preferred stock, or we call the hybrid securities, and the other one is the common stock. We call it the preferred stock as a hybrid security because few of the characteristics from the bonds it carries, and few characteristics from the common stock it carries. So it is somewhere in between. So its characteristics are the mix of the characteristics of the common stocks and the bond. So for example, first of all, there is always a par value. Par value is the face value of the preferred stock, and like we pay the interest rate, we need to pay the fixed dividend for the preferred stock. But in case of bond, it is mandatory to pay the fixed interest payment. But in case of preferred stock, if the company's management does not feel that they need to pay the dividend right now, the dividends are fixed in case of preferred stock. But if they feel that they are not in a position to pay, and the company is still struggling, or company needs a lot of reinvestment of their whatever the income company is generating, they can simply do not pay the dividend to the preferred stockholder. But that preferred dividend, the dividend of the preferred stock accumulate over the period of time. So for example, if in the first year, if they were supposed to pay say $1 against each share, and they have not paid, and in the second year they again have to pay the same $1, and before now paying any or distributing any profits to the common stockholders, first they have to pay the dividends of the even previous years to the preferred stockholders. So in case of common stockholders, they simply say, okay, last year whatever is the dividend we have not been able to pay you, the management will say we'll not pay you this year for the last year, but yes, from this year we'll pay or we will distribute the income to you. But in case of preferred stockholder, they also have to pay any the dividend which they have missed from the previous year. So before paying to the common stockholder, first they have to pay the dividend to the preferred stockholder. So that's why the dividends of the preferred stockholder accumulate over the period of time. So once it will be paid to the common stockholder, before paying to the common stockholder, all the previous dividends which they were not able to pay, they have to pay to the preferred stockholder. So yes, there is a fixed dividend in case of the preferred stockholder, like we have a fixed interest payment in case of the bondholders. But again, there is a bit flexibility. In case of bondholder, they definitely have to pay, say, after every 6 months, the interest payment. In case of preferred stockholder, that is not mandatory. Then there is no maturity. Like in case of bond, there is a maturity date. Like after some time, if there is a 10-year bond issued today, after 10 years, it will mature. In case of preferred stock, if you have bought the preferred stock, there is no maturity date unless the preferred stockholder will not sell it, or they will be called back or rebought by the company. Then if you see there is a priority of on the assets and earnings of bondholder, preferred stockholder, and the common stockholder. In case of the assets or earnings, first right belongs to the bondholders because they have lent the money. Once their proceeds are settled, whatever is the assets or earnings left over, like then in case of liquidation, if the company goes bankrupt, the right belongs to the preferred stockholders. Their whatever is whatever is the company has borrowed, like taken from them, or whatever finance they have financed the company, the amount of money with that money has to be settled by the company's management, and then whatever is the leftover, that is actually paid to the shareholders of or the common stockholders. So it means that the common stockholders are the at much more risk, compared to the other two group of investors. But at the same time, if the company is doing good, then whatever is the earnings left after paying the interest payment to the bondholders and their proceed, and paying the fixed dividend to the preferred stockholder and their proceeds, whatever is the leftover, that belongs to the shareholder. So the shareholder is actually as much more risk, but at the same time, they can get the maximum return if the company is doing very good. In case of voting rights, then usually the preferred stockholder do not have any voting rights. It's only the common stockholder who has the voting rights. So they can vote on the important matters of the company. And there is usually the convertibility clause as well. So the preferred stock, which can be converted to the common stock at the option of the investors, that if that convertibility clause is included in the contract of the preferred stock contract, then they can convert their stocks, the preferred stocks, into the common stocks and come into the class of the common stockholders. In case of common stock, again, we same have the par value, some fixed value. Say if a company's investment bankers who are floating their shares for the first time through IPOs in the stock market, if they have assessed that the price of each stock should be $30, so that's actually might be the par value. And if it is sold above that, so the $30 will go as a par value, and then the rest, let's suppose if it is sold for $57, the rest $57 minus the 30, which is the par value, will go into the paid in capital. And the price of the stock simply depends on the demand. So the par value can be different, but if the demand is much more, then that can drive up or bid up the prices of the stock when the stock will be issued for the first time into the stock market. Now, the common stockholder, they are entitled to receive the dividends, but again, it totally depends on the management that whether they are going to give the dividends or not. If you see the new companies or IT companies in the growth industry, they usually plow back or put back all their income back into the company and reinvest it because they can see the growth. But if there is a mature company like Walmart, they keep paying certain portion of the dividend, or general elected, they are actually in the mature phase of their life cycle, company's life cycle. So they are now outside the growth cycle. So some portion of their earnings they pay as a dividend, and then rest they can reinvest in the company in the shape of retained earning. So they are retaining the earning, but some portion they can pay as a dividend. So it means if you are a common shareholder of any company, you are entitled to the dividend, but it is not mandatory that you will receive the dividends. So the company can simply say, we are not paying the dividends and we are putting the money back. So in fact, many investors, they do not want dividend because you will be double taxed. First, the company has to pay the tax on their earnings, then whatever dividend you'll get, you have to pay the personal tax on the dividends. And in fact, many investors want their dividends to get reinvested rather receiving the dividend. They want the company management not to pay the dividend and put it back into the company, which is also a good sign or signal to the investor that the company is progressing and there is a growth opportunities. They have projects on which they can invest. Again, over here, the maturity date is not there like in case of bond. So both for preferred stocks and common stock, there is no maturity date. And you can have the ownership of stocks maybe for 50 years, 60 years, or whatever period you want. So we are considering, first of all, our assumption is that the companies are going concern, and if they have floated the stock, and if you have bought it, obviously then there is no maturity date until you do not want to go back and sell it in the stock market. Now, these are the important terms which we need to, because we will be doing some calculations using the dividend discount model. So these all the hats, if you see this over here, D hat T, this hat means the expectation. So D hat T means the dividend expected to be paid at the end of the year T. Then PT is the price, expected price, because hat is there, of the stock at the end of the year T. P naught is the price of the stock right now. So this P naught is right now. If there will be a hat, then it means we are trying to estimate find the expected price of the stock today, right? G is the expected growth rate in dividends. If dividends can usually grow, and some investor who wants dividend, they want obviously their dividends to grow over the period of time. Then S is the required rate of return on the stock. So this is the minimum rate which investor demand to invest in the stock. That's a different topic, how it is calculated. Like there is a CAPM model, capital asset pricing model, but that is a separate topic to discuss, and I will discuss it in another video. Now, D1 hat, which is the expected dividend by the end of the first year, divided by the price right now, which you are paying for the stock, that term is actually the expected dividend yield. So say if you have paid the price P naught right now and bought a stock for say $100, and after a year you receive the first dividend by the end of the first year, D1 hat, and that dividend is again expected. You are making an expectation that yes, this stock will give me $5. Then what would be your expected dividend yield? Your expected dividend yield will be D1 hat divided by P naught, right? Now, after a year, when you will receive the actual dividend, that no longer becomes D1 hat. That will be actually D1, because after a year, you will be able to know exactly what dividend you received by investing into that stock. So, in order to find the dividend yield, the real dividend yield, you will divide the D1, not D1 hat, with the price which you have paid for the stock. Then there is another way of getting the return. It's not the dividend which gives the return to the shareholders. The other one is the price appreciation. Might be after a year, the same stock which you bought for $100 you'll be able to sell it for $100 or $10 and end up getting a gain. Or maybe at that time market will be low, and you might end up selling that $100 stock for $90. So in that case, it's actually a loss. But we will categorize, or we will name it as the capital gain yield. That yield is an analyzed concept. So you get a yield, calculate a yield over a year. So if after a year you are expecting that your price will be P1 hat, this is the expected price, minus P naught, which is the price right now which you are paying for the stock, divided by P naught, again the price which you are paying right now, that will give you the expected capital gain. And again, the expected is the word expected is there because you are making an expectation about what would be the price of the stock after a year. So P1 hat minus P naught divided by P naught will give you the expected capital gain yield during the coming year. Now R S hat, this is the expected rate of return during the coming year, and it is actually the sum of the dividend yield plus the capital gain yield. So in other words, your expected return is actually the sum of this term, expected dividend yield plus the capital gain yield, and that will generate R hat S. If your expected return, let's suppose if you have some data, you calculated the expected return, it is more than or equal to your required rate of return. The required rate of return for investing in a stock, it obviously depend on the risk factor. If there is a high risk, it's more common sense that you will ask more return. So in the finance, these cons the these two things, the risk and return, they actually move side by side. So if there is a high risk, you obviously need more return, and if there is a low risk, you will settle with the low return. For example, in a real world example, if you see that there are saving accounts and they are very much safe, and that is the reason the bank of give you a very low return on that, and you are happy with that because you know that your money is safe and you end up getting the very low return. But in stocks are very risky. A stock can be all over the place. You recently the markets are down, so you can see that since coronavirus, market earlier went down and then went very up, then again down for few days. So you know that there is a lot of fluctuation, and the fluctuation suggests there is a risk. So when there is a lot more fluctuation, there is a lot more risk, and when there is a lot more risk, it means that the investor needs more return to get compensated for that. Compensated heavily by having a higher return for a higher level of risk. So if that risk level basically define what investor needs, what is the required rate of return on investing in a specific stock by the investor. So if your expected return, which you will do through some calculation, and we'll see in next few slides that how we can able to calculate it, it will be greater than or equal to the required rate of return what you need on that stock, then obviously it's a good investment. If your expected return on investing in the stock is less than the required rate of return on that stock, it's obviously a bad investment. So this is not a rocket science. And also remember, what is P naught hat? It's the expected price right now of any stock. But then there is an actual price at which the stock is getting traded in the stock market. If your expected price of the stock is more than the price at which the stock is getting traded on the stock, you will buy it, because you will say that the stock right now is undervalued, and these market participants in the stock markets, they are actually paying low, and you have ended up calculating the higher expected price of that stock. And it will be overvalued if it will be the other way around, where the expected price is actually low, but so P naught hat is actually low, what you have calculated. So all these expectation, you will be doing the calculation of that. And then P naught is the actual price of the stock. If that is high, it means that the stock is getting traded at a higher price in the stock market compared to what you have calculated. So for you, that stock is actually overvalued, and you might not do the investment in such stock. Now, how we will do the evaluation? So we will start with the most important model and the very basic model, and that is the dividend discount model. And the concept of dividend discount model to find the price of the stock or the value of the stock today is almost, in fact, it's similar to how we price the bonds. So what we do in the bonds, in bonds, we try to find out that what is the interest, and then find the present value of all the interest associated with that bond. So we find the present value of all the interest which that bond will give us, plus the present value of the face value which the bond will give us, and we add them together to find the price of the bond. In the same way, we will do the calculation for the stocks. So we will make an expectation that, okay, what would be the dividend that the stock will pay us after 1 year, after 2 year, after 3 year, after 4 year, and for on. Remember, there is a no maturity life of the stock. So once you buy a stock, unless you do not sell it, it will remain there, and we assume that the company which has issued this stock, it will remain a going concern, because this is actually the purpose of a company. It's there forever, unless like something happens and it will wind up. So there, the maturity date of the stocks are not there. So in other words, all the cash associated with the stocks will define the present value of the stock, like what is should be the price of the stock. And we will make an expectation. I know it's a very big assumption, but that has to be some reasonable grounds. I'm not I will not illustrate a real company over here in this knowledge module, because first I want to teach over here the technique which is used, and then we will later on can use any real company to find the price of the stock using this technique. Like we will apply this technique on some real firm, but in this knowledge module we will first go and focus only on the technique. So if you see, this is a stock, and after 1 year the first dividend, expected dividend, will come. So you are doing the investment over here right now, end of the period 0 or year 0. After 1 year, we have, in order to keep things easy, I'm considering that it's basically the dividends are coming after each year, right? Usually the dividends are declared after each quarter, but in order to keep the calculation easy, I'm assuming that dividend is coming after each year. So at the end of the first year, the first expected dividend is there. At the end of the second year, the second expected dividend is there. So you have not you have not gone into the future. You are standing somewhere over here and making the expectation of dividend 1, dividend 2 after second year, dividend 3 after the third year, and you can see that there is an infinite dividend, because the companies are going concern and there is no maturity value of the stock. If now we will discount them back and find the present value of D1, expected dividend, which will receive at the end of the first year. And how we will do it? We will obviously divide the D1 with 1 plus the required rate of return, what you need the return for investing in this stock, and the return is directly related to the risk of the stock. If the company is very risky, obviously your required rate of return on this company will be high. If the company is less risky, for example Walmart or any utility companies, then your required rate of return on them will be relatively low. So you divide them with 1 plus the required rate of return. What about D2? You will again find its present value. How do you do it? D2, expected dividend, you will receive after D2 at the end of the second period, which is D2 hat, divided by 1 plus the required rate of return raised to the power 2, because there are 2 periods, right? So you have to discount 2 periods back. In other words, you have to take away the return added to the cash flows over the 2 period of time, right? So if, in short, we will keep doing it and find the discounted value or the present value of all these future cash flows and add them together. So you can see this is a summation sign. This is the summation sign, and we sum all the present values of these future expected dividends. We'll find the expected price of the stock, which we also call stock's intrinsic value, right? So this should be the actual value of the stock. But remember, there is the main assumption you have to make, the assumption about the dividend, and again it's a very big assumption. There is no guarantee, but we are trying to make some calculated guess about the present value of the stock. So once you have all, we will able to find this will what this first term will give us. This will give us the present value of the expected dividend which you'll receive at the end of the first year by investing in this stock. Then this D2 hat is the dividend, because dividend is the cash flow which is attached with the stock, right? So the second dividend which you'll receive at the end of the second year divided by 1 plus required rate of return raised to the power 2. And in the same way, you have to discount all the dividends, future dividend, expected future dividend of this stock with the required rate of return. But maybe at this time you are confused, and I was also confused when for the first time I saw that, because if there is unlimited dividends, how you can do it, right? You have to keep expecting the dividends, which is not possible, and divide it with 1 plus the required rate of return, whatever is the period, and then add them all together. This is the way. Is this the way how we will find the intrinsic value of the price of the stock? Yes, this is the way. But the good thing is that we will see that we will make another big assumption about the constant growth of the dividend, which make this formula very easy for us, and we do not have to basically calculate these unlimited terms in order to find the price of the stock. And we will see very shortly how that thing will work. Now, valuing the stock with the constant or normal growth, that's important. We'll start with that. And why we will do it? Because this assumption that there will be a constant growth of the stock, for like the stock can grow forever at a constant growth, will make this technique work for us. And we do not have to discount all these dividend for unlimited dividends forever, right? So this technique, we'll look into it. And is this assumption is right? Yes, because after some time, every company from the growth cycle, they go into the maturity phase of their life cycle. So first there is a growth phase, and then there is a the maturity phase. In the maturity phase, in the growth phase, they aggressively grow. But once they enter into a maturity phase, more competitors will come in, there is more competition, then the growth is not very fast, and then the companies grow at a constant growth rate. So that assumption that there will be a normal growth or a constant growth is very fine. So we will denote it with the G, and we will use it in the formula. We'll see that. Also, it is expected by many investors, stock investors, that the dividends will grow at least with the GNP, whatever is the gross national product, or like of the country. So, and it is actually whatever is the production of production of the nationals of a particular country across the globe, plus some inflation they want to get. So normally it is somewhere 4 to 5 or 6, 7%. So they expect that the dividend at least grow within that range. So this assumption about the growth, constant growth of the dividend of a mature company is very much realistic. Many the investor actually expect the company to give a dividend which grow at a constant rate. And why we are again doing it is a big assumption, but that assumption will make our discounted dividend discount model technique work. Otherwise, we'll keep discounting unlimited dividend, and we'll see that with that constant growth assumption, our formula to find the price of the stock will be very simplified. And here you go. This is the formula to find the price of a stock if there is a constant growth. So if the dividend is growing, say by 5% year after year. So right now, let's suppose the dividend is $1. So what would be at like the dividend after a year? At 5%, it will be $1.05, right? So you can simply multiply the dividend with 1 plus 5%, right? So that will give you the dividend after a year. Now, what would be the same $1 dividend which you are receiving today after 2 years? It will be actually $1 into 1 plus 5% raised to the power 2, because there will be 2 times the growth will be added into it. So that's why we are taking the power 2. And this is how we will get all these future dividends, right? Future dividends. So these future dividends after a year is now D naught, which is the dividend right now, 1 plus the growth of that dividend raised to the power 1. Then in the subsequent period, means the second year, it will be the same D naught into 1 plus G raised to the power 2, and so on and so forth, right? So if the dividend is growing at a constant rate and you want to find the expected price today, remember, growth is a big expectation, that what would be the growth, or by what your dividend will grow. And if you will discount it at your required rate of return, so we are discounting it over here by 1 plus required rate of return raised to the power 1, and then for the second dividend which we will receive, we are basically dividing it with 1 plus required rate of return raised to the power 2, so on and so forth. But if there are unlimited dividends, because we are assuming that there is no maturity of the stock, and the companies are going concern, so it means that there are the unlimited dividends attached to this stock. We have to it would be very cumbersome to discount each of those dividends and find their present value, and then add them together all over here to find the expected price of that stock today, like of that share today. So this, when there is an assumption of a constant growth of the dividend, this whole thing can be summarized over here with this formula, right? Rather discounting unlimited times, this is the small way of finding the answer. D naught into 1 plus growth divided by required rate of return minus growth, which is actually equal to D naught 1 plus growth is actually the next dividend. Remember, D naught is your dividend today, and you are growing it with by the G percentage. So 1 plus growth. So this will give us the expected dividend at the end of the first year, and then we are dividing it with the RS minus D. I'm not proving it over here algebraically, but you need to remember it, that whenever there is a constant growth of the dividend, when you do this assumption, you apply this formula. Now again, I'm repeating it, that first of all, is this assumption is necessary? Yes, it is, because how can you basically keep discounting unlimited dividends, right? With let's suppose there are unlimited dividends, it's not possible, right? But with this assumption that there is a constant growth, we can turn all this equation into this small formula. And yes, this is now possible. We can simply, based on the today's dividend, we'll multiply it with the 1 plus the growth, what we are assuming, and we convert it into the expected dividend next year, and divide it with your required rate of return for investing in that stock, minus the growth of the dividend of that stock, and we can easily find the expected price. Number two thing, whether this assumption is realistic. Yes, it does. As I earlier mentioned, the companies go in their life cycle through different phases. They might be initially at the growth phase, at which the dividend do not grow at a constant rate, and most probably in the growth phase they do not issue the dividend at all, right? Or if they do, then like there is no growth pattern in the dividend. But after some time, when they enter into the maturity phase, they start giving the dividend, like some specific dividend, and they start distributing their earnings in the shape of dividend to the stockholders. And the investors who are expecting the dividends, they actually want companies to pay them the dividend, which is growing at some rate, some constant rate. And normally this is whatever is the GNP, gross national product of the country. And what is gross national product? Like whatever the productivity is of the nationals of that country all across the globe. Like if I'm a Canadian, it does not matter, I'm sitting in India, Pakistan, Saudi Arabia, whatever services I'm providing, whatever is basically my production, we add up the production of all the Canadians across the globe and see that how it is growing over the period, plus some inflation which we have to meet. So you can say that 5, 6, 7% growth, and tentatively every investor who needs the dividend, they want in their dividend that their dividend should grow at some constant growth. And it also makes sense. If your dividend is not growing, then the according to the dividend discount model, then the current value of your stock will be less. The price of the stock totally depends on the cash flows associated with the stock, and these cash flows are the dividends, uh, or the final price. Let's suppose after 10 years, if you want to sell this stock, so whatever the 10 dividends you will receive, let's suppose I have invested today in on January 1st, 2021, and after 10 years I want to sell it, and then the next 10 dividends I is my cash flow from investing in that dividend, in that stock, plus the price at which I will sell that stock in the 10th year. So if I will discount them back, I will be able to find the price of the stock right now. And remember, the last price which I'll get after selling 10 years, that again depend on the future dividend there onwards, like after 2031 onwards, what cash flows will are associated with the stock. Again, it's a calculated guess what we are doing, but reasonable. It has to be a very reasonable guess, because you actually do not know what your dividend will turn out to be even after 2 years. So all these future cash flows, we have to make some calculated guess. And again, in this knowledge module, I'm focusing just on the techniques to evaluate the dividend, but in another video I'll use the dividend discount model on a real company to show you that how we are making, or we are trying to making a calculated guess about the future dividends, right? Or future dividend and the growth, the expectation of the growth. Because main thing is not about the dividend. We are actually will be ending up making the expectation about the growth, that by what the dividend will grow over the period of time. Because if you have a growth, then this year dividend will be multiplied with the 1 plus growth, and we'll be able to find the next year dividend. And then again, we'll keep multiplying all these dividends with 1 plus growth, because the dividend will keep growing with the same growth rate. So it's if we'll have a good calculation or assessment about the growth, we'll have all the future dividends. But in short, now you remember that first assumption in the dividend discount model is that there will be a normal or constant growth, and this, if you have that growth, you can simply, using this simplified formula, you can find the expected price of the stock today. Now look over here. If this is the data, like you receive the dividend right now $1.06, and the growth you are assuming of this dividend is 5%, and your required rate of return is 20%. So it seems that stock seems to be perceived very risky. That's why you need 20%. 20% by historical standards is a very high rate. So if you see, yes, the dividend will grow. Can you see? Because this blue line is showing the growth of the dividend over the period. So this is the timeline, which is actually 0 year, 5 year, 10 year, 15, 20 years. And over here we have a dividend, the value of the dividend. So after 5 years, if we have to find the dividend over here, that what would be the price of the dividend after 5 years. How do we do it? We simply multiply D naught 1.6 with 1 plus the growth rate, which is 5%, raised to the power 5, because this is how we will be able to end up getting the dividend over there, right? So you can see the blue line is increasing, which totally makes sense, because the dividend is growing at 5% rate. But we are more interested that what are the present value of those dividends, because once we're able to find the present value of all these cash flows, dividends, in other words, associated with stock, the stock, and we add up all the present value, we'll be able to find the price of the stock. So if we are talking about I would encourage you to take out the calculator and pause the video over here and tell me that what would be the price of this stock after after 5 years. So 1.05 raised to the power 5, right? And then if we'll multiply it with the current dividend, which is D0 1.6, we'll get $2.04 approximately. So the dividend after 5th year will be received as $2.04, given our assumption of growth of 5% in dividend. But what would be its present value? Its present value is simply you divide that with 1 plus the required rate of return raised to the power 5, because you have to discount them back. So that will give you the red dot over here. So this is over here. The red dot right above 5 will give you the present value. And you can see that even in terms of face value, the dividends are growing, but their present value is decreasing. Why is it so? Because the dividend is growing at a lesser rate compared to it is decreasing. Compared to the rate at which we are trying to find the present value. So they are growing just by 5%. But when we are discounting it, we are actually discounting it with the bigger number. It's the rate by which we are discounting is more than 5%. That's why that even this blue line is basically upward, like it is moving upward, but this red line is actually going down, because this is representing the present value of all of these dividends. So the face value of the dividend is increasing, but their present worth, the worth of this future dividend to the investor, is actually decreasing. And this is important concept. So you can divide 2.04 with 1 plus the rate of return raised to the power 5, and you will be able to get the answer. So I'm doing it with side by side. So 1 plus required rate of return, which is 20%. So 1.2, remember 20% in decimals is 0.2, right? So 1 plus 0.2 is 1.2 raised to the power 5, and this will we have to basically divide 2.04 with this, and the present worth is just 81 cents. So what we will receive after 5 years, and at this data, its present worth is 81 cents. In fact, 82 cents if I'll do some rounding off. But the face value will be $2.04. So this is this fact is now very much clear that the growth is at a lesser rate, but the discounting by which we are trying to find the present value is at a higher rate. So that's why this red line is lower, even though this blue line is going up, because this red line is just representing the present value of these dividends which we will receive in the future. Now this is actually now getting more clear, the same thing I was telling. So I do not know why it's 2.0. I think it should be 2.04. I think I tried to round it off, and this we can see that even though on the face value, the after 15 years, the dividend, which, so you started with 1.6 and the growth was 5%. After 15 years, if you will multiply 1.6 with 1 plus 5% raised to the power 15, you'll get $3.33 in the shape of dividend. But what is the present worth of this $3.33? Only 0.2, because we discounted it with 20%. So this is like very important fact to remember. After 25th year, the dividend on the face value is $5.42. But today, when the investor is investing today, right now, the present worth of this $5.42, which he will receive after 25 years, is almost near to zero, right? I'm 100% sure it's not exactly zero. This is just rounding off what I did, but you can do the calculation. You simply divide this one 5.42 with 1 plus the required rate of return raised to the power 25, and you will get the exact answer. Now let me check it with you. 1.2 raised to the power 25. Whatever I got, I need to divide the 5.42 with that number. And let me check that. So I'm doing it on the calculator. So it is actually just 6 cents, right? So it has to be over here 6 cents. That makes more sense if I will do it over here. And just give me a second. So if I'll be able to type in, I will definitely want to change this number. For some reason, yeah, this is 6 actually already. It's actually just like the size of the box which I selected. It was actually it was smaller. So it is now clear that as we start going into the future, far into the future, the cash flow of the distant cash flows, their worth will be very less to the investor who is doing the investment right now, right? So this, let's move ahead. Now this was the previous one was the case when there is a normal growth, right? And we'll see a question related to this in this knowledge module later on, but let's go to another situation. So this is the version of the dividend discount model where we have a constant growth, where the dividends are growing at a constant rate. So, and we know that this is the life-saving formula we have. We will not be discounting unlimited dividends now, and with this dividend, like we can easily find the present value, right? With this formula we can easily find the present value. Just we need the next year dividend to find the present value today. Now there is another thing. Let's suppose if I want to find the present value or the value at the end of the fourth period. Remember, this P note is showing us that what is the price of the stock at the end of the 0th period. And what is the 0th period? It's simply a convention to say that the time right now, right? And in order to find that, we needed the very next period, end of the next period's dividend, and that is how we're able to find the price. What if I will ask you to find the price of the stock at the end of the fourth period? What will you do? Just pause the video, think over here. I think you were able to figure it out. Then in that case, I need the D5. If I want P4, then I need D5, like the dividend at the end of the fifth period divided by RS minus G. And this is very important to remember, that if we want to find the price of the stock, expected price of the stock at any period, we need the very next period dividend. So if it is D6, then if it is P6, like the price at the end of the sixth period, then we need the dividend at the end of the seventh period, D7 divided by RS minus D. And if someone will give you simply D0, how you can find the D7? You will basically multiply D0 with 1 plus whatever is the growth raised to the power 7. So you move that 7 periods ahead, right? So this is important to discuss over here. So just keep it in your mind, and maybe you need to apply it in some of the question, and we'll also see in one of the question that how this concept is important. Now the second case is where the growth rate is 0. If the growth rate is 0, what will happen? This becomes 0, and we will end up getting D0. D0 into 1 plus 0 is D0, right? Because 1 plus 0 is 1. So we multiply with D0, we will get D0. So in other words, the dividend remains the same and it will not grow forever. And what is what could be the security which will resemble with this situation? Yes, the preferred stock. In case of preferred stock, there is a fixed dividends, right? So simply we can, rather writing D0, we can simply say it now D, because that D0 which the preferred stockholder will receive today, after 1 year they will again receive the same, after second year they will receive the same D0, right? So we can rewrite that D0 as D. And if you see that when there is a fixed payments come at the end of every period, and the period is basically fixed as well. So after equal interval of time, if the fixed payments keeps coming, say after 1 year and then after again after another year the same payment come, then after another year the same payment will come. So fixed payment after equal interval of time. And if we divide, first of all, what sort of situation is that? That is actually the perpetuity. Remember, perpetuity from your concept of time value of money. And if we want to find the present value, expected present value of such the security today, which are giving you the payments forever, the fixed payment after equal interval of time forever, we simply divide D with the required rate of return. So we can see that in the over here in the formula in the numerator and denominator, because G is 0, so we will end up getting the expected price of the preferred stock or this perpetuity today as D divided by RS. So with 0 growth rate, things are very simple. Simply D divided by RS. Now, sometimes you need to find the expected rate of return on the stock, right? How you do it? You will divide. There are the expected rate of return on a stock is actually the sum of two components. One is the expected dividend yield, and the other one is the expected growth rate by which the stock value will grow, or the capital gain yield, right? Or by which the price of the stock will grow, right? So for example, again, I'm keeping the thing simple. You you have a decision to take that I need to invest today in a stock, and the price of, say, that stock is $100. After a year, you are expecting that historically, on an average, say, if the stock is giving a dividend of, say, $5, and you will assume that you have a reasonable you have some solid reasons to believe that in the future, after 1 year, the stock will give the same $5. So what would be your dividend yield? What would be your return in a year based on this data, where you will be investing in a $100 stock today, because this is the price of the stock in the stock market, and after a year you are receiving $5. So obviously we know by this time it's a simple calculation, it's a 5%. So your return from the dividend, which is called the dividend yield, return from the dividend after a year, remember, yield is an annualized concept, right? So after a year it is 5%. Now, if your stock will grow, and if you are expecting, again, it's a growth. Someone has told you that the growth of your stock is the 10%, or the capital gain yield is 10%. It means that some people is assuming that after a year, the price of the $100 stock will turn out to be 110, and this is how you got 10%. $110, which will be the price after a year, minus $100, which you invested right now, divided by $100. So you will end up getting 100, and you end up getting 10%. So 10% plus 5% dividend yield, the overall expected rate of return is 15%, right? So the 15% came from two components: dividend yield plus the capital gain yield, we can also say it's a expected growth rate of the stock. Now, you need to remember that this is the expectation. Might be after a year you will go. When you were buying this stock, this was your expected rate of return, that this will be your expectation of the rate of return based on the D1 and the growth which you have expected. But after a year, say if the company simply said, oh, this year was a very terrible year because of, say, coronavirus thing, we did not able to make a lot of money, and we have to reinvest in our growth, and we have to start new project in order to remain sustainable and keep competing against our competitor, then your dividend yield is 0, because even you invested, some XYZ unexpected events happened, so you didn't get anything. And the growth also might have gone down, and the same stock, if you want to sell, and let's suppose if you went to stock market to sell it, and the price is 107. Now if you will sell what would be your capital gain yield? 7%. 107 minus 100, which you invested, divided by $100, which you invested, right? So $7 you extra got. $7 divided by 100, you got the 7%. Now the actual rate of return after a year is 7%. But what was your expected rate of return 1 year back when you were when you are making the decision to buy the stock? It was 15%. So there is no guarantee that you will actually get the exact expected rate of return. And if there is a fluctuation between the actually realized return and the expected rate of return, this is the risk factor. And we will discuss this risk factor and in the knowledge module or the topic of risk and return, that how if the actual return is different than the expected rate of return, then that fluctuation is associated with the risk, and with the higher risk, the investor actually needs more or demand more return for investing in such stock. So we have already discussed the growth of the a special case where there was zero growth. So in fact, I have moved backward. I have to go forward. Now, what about this situation? And this is more realistic case. So first case was in case of dividend discount model was when there was a constant growth, and this is a big assumption of the constant growth. The second was the case when there is zero growth, like for the preferred stock, so when the dividend is not growing at all. The third, remember, when I'm talking about the growth, I'm talking about the growth of the dividend. The third case is valuing stock with non-constant growth, and which is more realistic assumption, because as I mentioned earlier, the companies normally go through different phases in their life cycle. First, they go into the starting phase, growth phase, then eventually they might go into the maturity phase, right? So this case where we have a non-constant growth makes more sense. But the issue with the non-constant growth is you can have unlimited dividends, and we will come back to the same situation where if there are unlimited dividends, how we can keep discounting them. So what we'll do, we will start with initial years, first few years of a company, where we assume that the growth of the stock is not will not remain constant forever. In fact, there will be a non-constant dividend. Maybe this year, if a new company has started with 2 cents of dividend, next year they might pay 5 cents. The following year they might again pay 6 cents or 5 cents, or keep paying just 5 cents for the next 3 years. But after 4th year, there will be a growth, a constant growth of the dividend. That makes calculation more easy. So first few years, we assume that the company might be in their growth phase, and where they do not want to commit to the heavy payment of the dividends, because they want to invest their earnings back into the company, because they are growing very fast. So they do not want to waste their earnings just paying or distributing it in the shape of the heavy dividends to the stockholders. So in the starting phase, they will have uneven or unequal, or like where there is no constant growth of the stocks, of the dividend of the stock. But after some time, you necessarily have to make this assumption in order to make your calculation easy. And earlier I told you that such an assumption is also very realistic, and that a mature company, once any XYZ company turn into a mature company, they start paying the dividend at a constant growth, right? So in such case is actually the value, basically such case is the case where we are applying the dividend discount model with non-constant growth. So there are few steps we have to remember how we do it. We start with the computing the dividends that are expected to be paid during the non-constant growth period. So it means that during the phase of the non-constant growth period, we basically uh, discount those dividends individually back, and they try to find their present values. But then at certain point in time, we make an assumption that here onwards the growth will be constant. So what we'll do, we will try to find uh, the the value at that point with the what do you say, with the constant growth formula, and eventually we'll try to find the present value of of uh, of the of the calculation we are actually able to make. This thing will be very clear with some calculation. So let's start with the calculation, and assume this is the data you have. Now there is a, if you, I will give you this task to find the present value of the stock, where the dividend will grow at 20% rate for next 3 years. So growth is constant, you can see, but it is only constant for 3 years. It's when we are talking about the growth, we want to talk about the growth which remain there forever for the rest of the life, right? So when there is only the same growth for the first 3 years, then this is a case of non-constant growth. Only for first 3 years there is a 20% growth, but then from beginning of the 4th year onward, the growth is actually the 5%. Now if we will apply this case of the dividend discount model, where there is a non-constant growth, means 20% was only for the first 3 years, by which the dividend grew, and because dividend is not growing forever at 20% rate, then in that situation you need to remember this thing, that this is a non-constant growth rate. For first 3 years it's just 20%, but from the 4th year onward, the growth is actually now 5%. So now in that case, what we'll do, we will first take the current dividend, which is given also over here, 1%, and we'll grow it by 20% for next 3 periods. So what would be the growth? Let me do the show you the calculation with the timeline. That will make life very easy for you. Look over here. That is actually the same data. So for the first three year, you can see that the growth is G1 over here in the first year, second year, third year. The dividend is growing by 20%. So what the dividend right now is $1. It grew to $1.02 after a year. How did I get it? By this formula. I multiplied $1 with 1 plus the growth rate, which is equal to 1.2. What? And then now I have to find D2, expected value. It's hat actually, remember, expected value of the dividend at the end of the second period. So now if I have to find it, how will I do? Either I multiply 1 with 1 plus the growth raised to the power 2, or either simply I take the previous dividend 1.2 and multiply it with 1 plus the growth rate 20% raised to the power 1. Just I increase it by 1 more period, right? And in the same way, I will find the dividend at the end of the third period. So 1.44 with 1, you need to multiply it with 1 plus 0.2, which is the growth rate raised to the power 1. Remember, I already have this number. I simply grew it by 1 period over here. So I got third dividend, expected dividend 1.72. So now I want to find, in the phase 1, I need to find the present value of this T1 over here. How will I do it? Pause the video again, try to guess it. Yes, you are right. You need to divide this 1.2 with 1 divided by the required rate of return. So the investor required rate of return is 15%. So it means in order to find the present value of the of D1 expected, this D1, all you have to do is you need to divide 1.2 with 1 plus required rate of return. Remember, it's 15% and we will always write in the decimals. Raised to the power 1, right? What you would do in case of 1.44, you will again manually do it for the present value of D2, right? Of D2, and again this is expected D2. Remember, this is just, you are making the decision over here right now about the future, and this is the scenario given to you that we are expecting that the first 3 years the dividend of $1 which you are receiving right now will grow by 20%, right? So this is all expectation what you are making, right? So how you will find this present value then? 1.44 raised to the, divided by 1 plus 0.15 required rate of return raised to the power 2. Now, but this way you are able to understand that how things will work. For this, we have to divide it with 1 plus required rate of return, which is 15% raised to the power 3, and we will find the present value. Now, this is good for 3 years, but you cannot keep doing it for unlimited time, right? Therefore, at one point in time, you make an assumption that the dividend of this stock will grow at a constant rate. And in order to use that technique of the constant growth, perpetual constant growth model to find the price of the stock. So we can do it from the year where we are assuming that the dividend will grow at a constant rate forever. So that was actually after the year 3. So we will assume that the first year which will be impacted will be the 4th year. So by the end of the 4th year, now this dividend, which is the dividend at the end of the 3rd year expected dividend, 1.728, it will grow at 5% and then keep growing forever for the rest of the life at 5%, right? So it means 1.728, in order to move to D4, D4, we have to multiply 1.728 with 1 plus the normal growth dividend, which we assume that will remain there for the rest of the life. And this assumption is very important to make our calculation easy. So we will multiply 1.728 with 1 plus 5% raised to the power 1, and this is how we'll get 1.8144. If you recall, what was the formula for the constant growth dividend when the dividend is growing at a constant rate forever? So the formula for the constant rate dividend was the P naught, expected dividend, the expected price right now is equal to the expected dividend you will receive next year, whole divided by RS, required rate of return, minus the growth rate, right? Now, from year 4 over here, this year, from year 4 onwards, the dividend is growing. We are making the assumption that the dividend is growing forever at 5% at a constant rate. And this is the reason why we can apply now this formula over here. But remember, when we'll apply this formula, this will give us the price not over here, but over here. So what dividend is the first dividend affected by the constant growth? D4. So instead of D1, we have actually D4. And we will not be able to find its price at P0. Actually, we will be able to find the price at P3. Right? So remember this thing. Because this is P0 and D1, in the same way, once if we have expected dividend at the end of the 4th period, which is actually the first dividend affected by the constant growth or this is the growth only for 3 years. When I'm talking about the constant growth, I'm assuming that the growth rate which will keep affecting the dividends for the rest of the life of the stock. So this I'm talking about. And the first dividend which is affected by such a normal growth or constant growth is actually this fourth dividend. So that's why we have over here the this one over here, the D4 dividend. So D4 divided by RS minus G will actually give me the expected price at the end of third period, right over here, not over here. So this is an important thing. So once we will find this price, so as if you bought this stock and you sold that stock at the end of the third year, so this price P3 will you receive at the end of the third period. But if you will not sell it, right, or even if you let's sell it, you will get the price at the end of the third year, right? So in order to find your real price today of this stock, you have to find the present value of this P3 as well, right? So I have done this calculation over here. So I found the present value of D1, this one over here today, and you know that why I have to do it. I have to find this is the future cash flow associated with this stock. So I have to find the price today right now. Then this is D2. I again have to find the present value of these two, and you can see the formula. I do not want to repeat it again and again. So then this is present value of D3, right? This is the D3 over here, right? Now with this formula P4, if we'll apply, just give me a second. I'm not able to draw something. Okay, so you can see over here that I'm able to find the P3 D4 with RS minus G norm. So again, I'm able to only use this formula because D4 is the first dividend. This has to be hat on top because this is the expected value of the dividend at the end of the fourth period. And why I am able to find the P3 rather P0? Because first dividend that is affected by the growth which will remain there forever for the rest of the life. Again, this is the assumption we are making, and we have to make this assumption. Otherwise, we'll keep discounting like this, like these two, all the dividend in future forever, which is not feasible. So in that case, we have D4 1.8144, which I got by multiplying the previous dividend with 1 plus 5%. And now this is the first dividend affected by the constant growth which will remain there forever, divided by the 1 plus required rate of return raised to the power 3. Remember this thing. You cannot apply this formula if your required rate of return is more than your growth. So because it becomes negative, right? Remember, if your numerator and it becomes negative because your required rate of return is small than your growth rate, then your price at the end of the third period will be negative, which doesn't make sense. How a price of a stock can be a zero, worthless, but it cannot be minus, right? So this formula can only be applied as long as RS is greater or equal to growth rate, right? So in that case, if you see, in fact, greater than growth. So in that case, you are able to find the present value as 80, not present value, the price of the stock at the end of the third period at $18.14 approximately. So now you have three present value of the D1, present value of the D2, second expected dividend, present value of the expected dividend of D3. Remember, all these are expected dividends, right? It has to be hat over here. I simply am not able to write it, but you should assume it as a hat because these are expectations which we are making right now, standing over here at the end of the zero period, which means right now. So then we have the price of the expected price of this stock at the end of the third period over here. In order to find the true intrinsic value based on our assumption and these numbers of the stock today, I have to discount this P3, the price of the expected price of the stock which the investor will receive at the end of the third period today. And how I will do it? I'll divide it with 1 plus the required rate of return raised to the power 3. Remember, I have to move 3 periods back, 3 to 2, 2 to 1, 1 to 0, right? So the present value of P3 I have to find over here, right? This is P3, which I have done already, right? And you can do it with the calculator. I have not specified. This is simply the price of the stock at the end of the third period, but you have to do the present value. So take out the calculator. I am taking it out with me, right? So if you divide the 18.144 with 1 plus the required rate of return, which is 15%, raised to the power 3, you'll end up getting the present value of the present value of the expected price of the stock at the end of the third period, and the present value is 11.93. You can pause the video again and check this number with me. Yes, guys, I have just double checked this number, and yes, it is 11.93. So now if you see, we are able to find the present value of this stock by finding the present value of the D1, D2 and D3. All these D3s were actually from the phase where the growth is there, but the growth will not remain there forever. So we will consider this phase as a non-constant growth phase, right? And then the from the year 4th, there is a constant growth which will remain there for the rest of the life, and we are making this assumption to apply this the constant growth formula and making our calculation easy. And again, I have already mentioned that this is a realistic assumption. We use this to find the present value at the end of the third period, as if you are selling this stock at the end of the third period, and you will get $18.14. Now, if you want to find the true present value today, you have to discount this cash which you will receive by selling it, the expected price which you will receive by selling it at the end of the third period. So once you discounted that back, you got 11.93. Now we have to add all of them, and if we'll add all of them, we'll get the present value of the stock as $15 and approximately 20 cents, right? I'm just rounding it off. So here you go. We start computing the dividends that are expected to be paid during the non-constant growth period. Continue computing dividends until you compute the last dividend that is affected by non-constant growth. Then, using the investor's required rate of return, which in my previous example was 15%, we'll compute the present value of all the non-constant growth phase dividends and find their present value. We sum them together, right? And the phase 2, where the growth now becomes normal and become constant and remain there forever for the rest of the life, and we are making this assumption. Especially this assumption is realistic when the companies will go into their maturity phase and the investors expect them to pay the dividend with the constant growth. Then in that case, we'll find first the present value of all the future cash flows and find PT. And what was PT in our example? It was the price of the stock at the end of the third period, because from the fourth year onward, the constant growth, which the perpetual constant growth, was hit in our calculation, right? So we will able to find P3, and once we have the P3, in order to find the present value of the stock, we have to further discount it back, which we have done. So the sum of the phase step 1 and then step 2, we will use to find the intrinsic value of the stock, and that is actually the expected present value today. And if you made those assumptions and this expected present value of the stock is less than the actual value of the stock, which is simply P naught, there is no hat on that, then it means that the stock in the stock market is overvalued. Your assumption is suggesting it should be uh, less, so you might simply not buy it. But if you're based on your assumption, the price, expected price, like P hat naught, is more, and the actual price of the stock in the stock market is less, you'll go ahead and buy the stock. Again, the assumptions are very critical. You can see that little bit wrong assumption can have a totally misleading direction for your decision whether you you should buy the stock or not buy the stock. So this was the example I already discussed and shown you on my notes with this data, and we have seen that the with the present value of D1, D2, D3, if we add them together, that will give us only 3.268. So in other words, if I'll be able to check, just give me a second over here. So you can see if you add only these three numbers, right? This one D3, the present value of D1, present value of D2, present value of D3, you will actually get this one, 3.2685. You can double check it. And then you also have to find the present value of the P3, like as if you will sell the stock after the third year, because why you were doing it, because the fourth year was the year where the constant growth, perpetual constant growth assumption hit. So from the year fourth, the first dividend that will be affected by the constant growth, which will remain there forever, was the fourth dividend. So using that, we were able to find the P3. Remember, D4 divided by RS minus G gave us P3. So this is the expected price which you'll receive. But that price, if you will receive at the end of the third period, you have to find its present value to you today. That turned out to be 11.93. And if you add that with the step 1 calculation, you'll get the 15.2, which I have just mentioned earlier. So what was the summary? We discussed about the basic characteristics of two types of stocks, preferred and common stock. And we specifically, there are many models, but in this knowledge module, we applied the dividend discount model to find the present value of a stock. The real company, this is already a very lengthy lecture. The real company is not used over here, but in in another knowledge module, I will use a real company to find the stock, the price of the stock today, that how it can be done. But at least the technique you will be able to understand with this knowledge module, that how we can apply this technique and use the dividend discount model to find the present value of the stock. Thank you.